All right, glad to have you back. As the global economy continues to evolve, Nigeria's ability to adapt and innovate within its financial markets will be instrumental in shaping its economic future. Experts say a resilient and dynamic foreign exchange market, complemented by a robust stock market, is essential for Nigeria's goal of achieving sustainable economic prosperity and financial stability in the years to come. Well, let's continue our discussion. I'm being joined by industrial sector analyst, Chapel Hill, Denham, Mr. James Ola Adisa. Mr. James, good afternoon. Thank you so much for being on the program this afternoon.
Thank you, Mr. Tudu. Thank you for having me today.
I think we should start from the foreign exchange market. After weeks of stability, I would say we've seen it between 1,400, 1,450. It's about 1,500. As I speak with you, hovering around 1,500, 1,550 naira, we still see a bit of, well, should I say hike? And there was a bit of gain and all of that. But let's look at this flip-flop that we've seen. What is your understanding of this stability that we see in recent times?
So the naira has depreciated by about 27 basis points so far this month, pardon me. And last month, it lost about 128 basis points against the greenback. Now, as you know, we operate a willing buyer, willing seller market, and that means that the driving factor is indeed liquidity. So if we do an analysis on how liquidity flows within the market, we'll see that FPIs have really driven the increase in FX inflows into our market. In Q1 alone, we had about $7.4 billion inflows. Out of that, we had about 33% accounting for foreign portfolio investors accounted for about 33% of that. And in Q2, we had about 6.5 billion, and about 28% of that came from foreign portfolio investors. Now, the decline that we've seen in inflows is as a result of a pullback in, FPI inflows. And, when we look at it relative to previous quarters, what we see is that previously, we had it on an average of around 3.5 billion flowing into our market, and it has increased significantly, right? So it speaks to an improvement in liquidity since the start of the year. And we've also seen this translate into a significant improvement in FX turnover. In H124 alone, we've had an average FX turnover of around $257 million, right? And if we look at what was done in 2023, about little over $100 million on average. Now, looking at 257 million relative to what we did in 2019, which is pre-pandemic levels, we see that we're just about 2.4% shy. And the way we look at it is that pre-pandemic levels, that's when we saw inflows into our market. The currency was relatively stable before the significant illiquidity in the market translated to the depreciation in the naira. And so we feel like the improvement in liquidity really helped the naira, and we saw an appreciation in the currency in the first quarter of the year. But as a result of the pullback in inflows and reduced CBN policies, there were no actions. We didn't see the CBN come out to sell as much in the market in Q2. That translated to a loss of the gains that we recorded, and in Q2 there was a loss of around 39.7% in the currency. The positive, however, is that we've seen a convergence between the parallel and the official rate, and it has largely been maintained. But the naira has continued to slowly lose value against the greenback, and in my view, I think that that's a result of the rising demand and the still limited supply relative to the demand that we're seeing now in the market.
A good breakdown there, I must say. But I'm going to follow you up now in two ways. First, talking about investors' confidence, which is paramount at this very time. All of these policies that we keep talking about, what does it mean for investors' confidence, looking at the transactions and some little flips of inflows that we've had in recent times? Some would also tell you that the attractive U.S. yields and pressure is adding pressure to Nigerian naira.
Yeah, I agree with that. Because of the liberalization of the FX market and the framework we operate with, it means that we have much more exposure to global monetary policies. And so you see investors, foreign investors, looking at the body language of the Fed before they make investment decisions. So if they feel like the Fed is going to keep the rate elevated, then they feel feel more comfortable leaving their money in safe haven assets like US Treasury, as opposed to looking for risk in countries like Nigeria. So in a way, that also affects the inflows into our market. And if we look at the stock market, foreign investors are very particular about how volatile the currency is, because it adds an element of risk to the risk they are already taking investing in a foreign equities market. And so that has been one of the contributing factors to the apathy that we've seen on the part of foreign investors towards the Nigerian stock market. Now, I must add that, if we look forward, we would see that the World Bank has approved about $1.5 billion US. There has been an additional 750 million, total of 2.25 billion, and this is expected to flow into the country, right? This should ease FX pressures. Now, we also have the fact that the CBN is also looking to consolidate and recapitalize the BDC segment of the market, right? And after the 6-month period of, since the guideline was published, we expect that the CBN will have, there will be a consolidation in the market, and then the CBN will have much more oversight over the segment and resume sales to the FX market. What that means to me is that, there's some light at the end of the tunnel. And if we see some form of stability in the FX market, then it could also translate to an improvement in foreign portfolio participation in the equities market in Nigeria. So right now, I think that, the sentiments around the Nigerian equities market, looking at it from the perspective of a foreign investor, is a little bit dampened. But if we look at it, what is to come, if we look at the expectations for the market, I think that, it would boost sentiment from foreign investors, and we could potentially see some improvement in their participation, given that, the FX rate, the FX market is relatively stable.
Looks good. Still looking at the market sentiment at the moment, and also the interest of growing possibility of Donald Trump's. Many say he might. Well, that's a possibility. I see the smile there already. And many say that there might likely more borrowing and increase in tariffs. All of that are affecting the market sentiments at this time. But as you comment on that, if you want to, what sectors should we be looking out for in 2024, despite the exit of some multinationals or taking over, whichever way you like to explain that?
Investors have to make the best use of the environment that we're currently in. And based on my view, I think that, the banking sector, despite the fact that, they are recapitalizing and raising fresh capital, provides an opportunity for investors. Now, you'll be able to participate in, their capital raising exercises, most of which is done at a discount. And given the fact that we're currently in a high interest rate environment, it still bodes well for the banking sector. And so you're able to buy into this stock cheap, and, the outlook for the sector is positive. And so there has to be some value for investors in that sector. Secondly, I think we should be looking at the consumer goods names. The FX losses really dampened sentiment around the sector. We saw huge FX losses at the end of 2023 and even up until Q1 2024. And, I think the worst is behind us. At the end of Q1 2024, the exchange rate was somewhere around 1,300, 1,400 levels. And now it's around 1,500, as you've mentioned. And so we don't expect them to, report huge revaluation losses, huge FX losses, right? These losses have affected their earnings, eat deep into, their profitability, and we don't expect this to materialize moving forward. And so because there were sell-off in this name, they now provide a potentially lucrative entry point for new investors into the equities market. So I think we should be looking at the banking sector, the consumer goods sector. There's also the oil and gas sector. Crude oil prices still remain relatively elevated. And for names like Seplat, they have huge expansion plans. And we think that this has value for investors. So these three sectors are sectors that investors need to focus on.
So what are you thinking about that politics in that crude oil market? I wanted us to touch on it. And you already alluded to their stocks now at the moment. What do you think is playing out in that space? OPEC quota, OPEC plus, non-OPEC members, everyone trying to be active in this very important market. How do you see all of this playing out? And with Nigeria, where we are talking about maybe reducing exports of our crude and start to do more of in-country refining?
So I think that the politics in the oil market globally is really has an effect on the demand and supply play, right? So if we look at OPEC plus members, they are looking at keeping their costs at, they're not looking at any new costs, right? So that means that supply is going to be limited. But we're seeing rising demand. There's also the element of supply chain disruption as a result of the geopolitical tension in the Middle East. Supply is also limited relatively given the geopolitical tensions in Europe. So we're looking at the Ukraine and Russia conflict. And all this have, in a way, kept prices elevated. And, the way we're looking at it is, for crude oil prices, I think that, given the current risk, they tend to linger. And if they do that, if that materializes, we might see, crude oil prices remain elevated. For Nigeria, I think that so far we've not been able to properly leverage the rise in crude oil prices. Our production levels have been, somewhere around 1.3, 1.2 million barrels. That's crude only, right? And because we've not been able to leverage this, we've not reaped the full benefits of higher crude oil prices. I think that with the refinery now in play, it definitely gives us an edge. I think that if we supply the crude oil that the refinery needs, we'll be able to supply the African market and also export to, the European market. And that would also, pull in some export earnings. And, when you add value to a product, you tend to, earn much more returns. And I think that if we're able to leverage the refinery, which is huge, 650,000 barrels per day, that's the capacity, I think we'll be able to, benefit a lot more from our crude oil and the resources that we have within the country.
Very interesting one. Now, before I let you go and wrap up this segment of the show, let's talk about that big statement from Africa's richest man. Yes, I like your views also on that. Interest rates, and we know that the central bank has been trying to do this to rein in on inflation. What do you make of this, and what impact does it have? Many will tell you that this is the time to put my money in treasury bills because the rates are looking pretty good.
Yeah, so it depends on the investor's horizon, depends on what they intend to achieve. But what I would say is,
hot money.
We have, yes, exactly, hot money. It has attracted foreign portfolio investors into our market. Currently, the treasury bill is around 20.7%. The OMO bill is around 22.5%. I think that these are very attractive rates, right? For investors who are not willing to take the risk in the equities market, I think that the fixed income market is definitely very attractive. But equities market, given the risk, also has the return. So for investors who are able to pitch their tents in fundamentally sound names that have positive outlook, in sectors that have positive outlook, I think that the equities market is also very attractive. But personally, I would say that the fixed income rates currently are rates that one should leverage on. 10-year bonds at 20.5%, right? And these are levels we've not seen before. Locking in at this level before, things will not remain the same. Things are going to change. Inflation is going to trend downwards at some point. And so I think that locking in at this rate is not a bad idea in the fixed income market. I think that it will definitely benefit investors, strategic investors who are looking for stable income. 20% coupon is fair.
A good way to live it. I must thank you so much. Interesting conversation with you as usual. Industry sector analyst is with Chapel Hill Denham, Mr. James Ola Adisa. Do enjoy the rest of your day, and thank you for joining Business Nigeria. Let's take another break.